market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. A global bond sell-off driven by geopolitical uncertainty. For Europe, it's a watershed moment for collective security. Oliver Crook is in Brussels as EU leaders discuss how to ramp up military spending across the bloc. Lizzie Burden is in Frankfurt for the ECB decision a little bit later as central banks navigate this new reality. But first, I'm joined by our EMEA News Director, Ros Matheson. Ros, there is, again, a lot going on, and you're seeing a lot of the spending plans now infecting a lot of the markets. The French president gave this address yesterday that was quite presidential but also quite worrying, where he talks about a nuclear shield. Is this just the latest effort to try and counter what's happening between the U.S. and Putin?
Well, it's really a signal that for Europe, at least, the fabric of the security umbrella involving the US is breaking down or is no longer seen as reliable, because for decades the US has helped provide that nuclear deterrent for Europe as a whole against perceived threats, including Russia. And France is the only EU state that has nuclear weapons. Obviously, the UK does as well, but is not in the EU. And a recognition, really, from Macron in that speech is that, well, we can't rely necessarily on the US to continue to provide that nuclear deterrent. So maybe France now has to provide that for the rest of Europe on its own. And obviously, that's a delicate one at home for Macron to say that. But we can see, the messaging that's coming from him in those remarks. And also after Germany, with the incoming Chancellor, Friedrich Merz, did actually say, France, maybe now you need to provide that nuclear umbrella. Again, all of that is saying we no longer feel we can rely on the US in the minute.
Yeah, and Ross, this is ahead of the EU leaders meeting today to discuss ways to unlock billions of euros to boost European and Ukrainian security. This comes after, as we were just discussing, Emmanuel Macron said he'll enter into talks to use the nuclear capabilities to defend European allies. So let's also go to Brussels, where Oliver Crook is standing by. Ollie, I mean, there will be a number of options on the table, but can we actually expect anything concrete today?
Yeah, I think we can. I think that we get sort of what we're going to get concretely are some of the outlines that Ursula von der Leyen laid out a little bit earlier in the week. And we're talking about unleashing hundreds of billions of euros and a bunch of different sort of avenues. One way is direct lending from the EU, 150 billion euros. They're talking about easing the fiscal rules. That would mean that basically member states would not be subject to the debt rules that the EU has over their members when it comes to spending on defense, i.e. you basically have no more limit in terms of how much debt you can accrue, debt financing defense. And what is a really peculiar and very interesting and probably the most significant part of what we're seeing right now is that you have an incoming German chancellor from the CDU, Friedrich Merz, who is actively lobbying on behalf of Germany to ease fiscal rules in the EU. That is something that is really without precedent, in addition to the fact that the Germans are now easing the debt brake, as we've talked about. So in a certain way, I think that Friedrich Merz's announcement is even more significant than anything we've got out of the EU. In a certain sense, he is the one who is making sort of the biggest waves as far as defense is concerned. And he's not even going to be in those leader meetings. He's not yet chancellor, though he is at the EPP pre-meeting, which is where we are right now. He just walked in where they're discussing with their lawmakers and other leaders within the EU, within the EPP party. But that is going to be the main focus today for European leaders. The other two things we're going to watch very closely for, Francine, is how active is the conversation about joint debt within Europe to defense, for funding defense, and also what are they going to do with these Russian assets? How active a conversation is that? And again, Francine, we should just say that on a day like today, we tend to look at the ECB for market moves and monetary policy, but right now it is all about fiscal. The ECB couldn't move German yield by 10, 20, 30, 40 basis points over 2 days.
Yeah, the ECB couldn't, but they have to deal with the fallout. Ollie, thank you. Ollie Crook there. Now, the European Central Bank poised to cut interest rates today for the 6th time since June, though a volatile economic backdrop is definitely sowing divisions over borrowing costs. Let's go straight to Lizzie Burden, who's in Frankfurt for us. Lizzie, I mean, if you look at the ECB, they have a lot to contend with. Market moves, growth, instability. How will they respond?
Yeah, you're completely right. And even before all of that news, Francine, on tariffs and defence policy, it was already kind of wide open what happens beyond the April meeting. Today, pretty much nailed on in terms of a cut, but the Governing Council really divided between the hawks concerned about sticky services inflation and higher energy costs, and the doves still worried about sluggish growth. If you look at the analyst path expectations ahead, some say that today could be the last cut, some say that you could cut all the way to 1% by 2026 at the start of the year. So today they are also, of course, going to be asked about all of you've just talked about in terms of the whatever it takes package from Friedrich Merz, the expectation that it is going to boost growth. Goldman saying it could be 2% for Germany, up from 0.8%. And most importantly, traders therefore paring their bets on ECB cuts this year. But then you also have to factor in tariffs, right? That is the elephant in the room. Donald Trump, the elephant in the room of this meeting today. But I'm sure that Christine Lagarde's position really is going to be we can't make policy or projections based on what is at the moment just a threat.
Lizzie, thanks so much. Lizzie Burden there at the ECB. There's full coverage of that ECB decision from 1:15 London time. Of course, with ECB President Christine Lagarde's news conference at 1:45. We're back with Ross Matheson. Ross, I mean, there's so much going on. I guess the million-dollar question is, can Europe stay united? Can they find the funds and try and get organized?
Well, that's the question for today's meeting also, because some of the things that they're talking about on defence, they don't need everyone in the EU to sign up for. They don't need that majority of all states to say yes. And so they can do it even if Hungary, for example, which is the one we're talking about, says no. But the really blockbuster fundraising that they will need if they are thinking not just about defence today, tomorrow, but 5, 10, 15 years, is do they have to look at joint financing? And that requires everyone in the EU to sign on. So the really high numbers that are possibly needed to build out these armies in the way that some European leaders are talking about, that requires the EU to row together. And it's very clear that Viktor Orban is a bit reluctant on some of that. He's certainly reluctant to have anything tied to more aid going into Ukraine. So how do you split that off? Where you talk about building your own defence, but not necessarily meaning that you're sending more weapon shipments and so on to Ukraine. So a lot of complexities to navigate. But even if we get there and EU leaders get to the point of saying this is what we agree on, weapons just don't magically grow on trees. I mean, you have to get contracts done. You have to get companies to agree to take those contracts, to build their production lines. They like certainty mostly from long-term defence contracts. If they're going to change everything that they're building and how, they want to know that contract's going to be there in 5 years. And so this stuff gets very slowly moving. But I guess the argument is if you don't start now, then when?
Yeah, thank you so much, Ross, for, of course, that terrific briefing. Our EMEA News Director, Ross Matheson. Now, coming up, German bonds extend losses, putting pressure on global debt markets. We'll get the view next from Joe Davies, Global Chief Economist and Global Head of Investment Strategy at Vanguard. This is Bloomberg. Welcome back, everyone. Now, German bonds extending their worst daily drop since 1990 following the nation's historic plan to boost defense spending. Now, the rout, of course, putting pressure on global debt markets. Let's bring in Joe Davis. He's Global Chief Economist and Global Head of Investment Strategy at Vanguard. Joe, thank you so much for joining us. I mean, there's a lot going on, and especially in the market space today, there's a lot going on because there's questions, of course, about how Europe and Germany can afford to do all of this. Where does this go?
Well, I think for Germany and for Europe, I think we're looking at, for the sustainable future, higher structural deficits. Now, why should I care as an investor? They're generally supportive for growth, not massively so. But I would say for investors, look at what happened in the United States 2 years ago. That was the primary reason neutral rates rose and the fair value on the 10-year Treasury rose. So if you map what may happen in Europe with the bonds and curve, that points to a neutral rate that's markedly higher than where it was just a few months ago. And this has huge implications, of course, for euro, dollar, for ECB, kind of for everything. So we're expecting fiscal more of a for us matters if it's sustained. That matters for the neutral rate. So what are you buying up right now? Well, again, I think you have to think about fixed income as an overweight in a position. We've been articulating that for clients for over a year, partly because of this structural higher neutral rate. You also have high valuations in the U.S. I mean, we've been on that theme for 2 years, and we're not going to pick the top, but we're underscoring, outside of the U.S. Europe seems more positive. It's more the U.S. exceptionalism, always had an expiration date on it because it's just unsustainable from a valuation perspective. But, Joe, overall, and this is something that, when you look at the U.S., people say that Donald Trump cares a lot about the economy and he cares about valuation.
valuations, and therefore he cares about the stock market. But if the end game is trying to get blue-collar jobs back to the U.S., this has bigger implications for the dollar, which is dollar actually negative or dollar down.
Yes,
right?
Yeah. So I think that this is the push and pull. I mean, you're trying to take on globalization, like head on. I think it'll be mixed success because some of these jobs are just not coming back. Some of the losses were technology driven. Right. But nevertheless, you could think of a governor on the process being an S&P 500 that doesn't drop too fairly. I'm worried about what I would call the uncertainty tax. Right. It's the change in policies, regardless of what the policy is, that will start to erode growth expectations below 2%. That is not our baseline. But if they continue to rise at the pace they have been and then hang there for let's say for the next 6 months, Francine, then we're talking about downside risks for growth.
And this is what CapEx, this is what
CapEx, business uncertainty. It's what a CFO,
spending?
yes, with consumer spending. I think it's really in the investment side. It's high beta, it's smart. But if you're a CFO right now, you just don't have to be in the auto sector to say, do I have as much confidence in my plans? That's where it'll really bite if it does.
But it seems that the markets are slightly off that, right? There's I mean, there's a correction, but how much
I think
more
they're underestimating that risk.
Yeah.
But we'll see going forward. Again, tariffs have been, it's a wild card scenario. China hasn't surprised us in terms of what we've seen. I was skeptical that the Mexican and Canadian tariffs would bite, just given the auto manufacturing disruption. It's tough to operationally incorporate, but that's the biggest risk factor.
Are tariffs inflationary?
They are in headline, but then you have it's a downside to growth. It nets out. It puts the Federal Reserve likely on hold. That means they rescind from the battlefield a little bit, where they've been a supportive for growth and for risk assets. If you have negative momentum through uncertainty and you have high valuations, that's usually not a good recipe.
When you talk about, U.S. exceptionalism at some point coming, if not to an end, pausing. I mean, would this be the moment under Donald Trump? This feels like a pretty bold call.
Well, again, our thesis was we were going to have an unraveling this year, or I should say, Francine, a weakening of some of the supply forces that were really positive for the soft landing narrative. It had less to do with demand weakening in the Fed. It had much more to do with labor supply, which was massive, and productivity lift. And so I think we see a little bit weakness there. The uncertainty tax is the wild card. I'm hopeful it won't continue to spike, but that's something if we're going to have a change in our forecast, it'll be because of that.
What are you expecting the Fed to do? Again, that's moving around quite a lot.
Well, we have some modest easing at the back half of the year. We debated the timing because of the stickiness of inflation. Again, tariffs are more of a push, and then it would be the uncertainty. Labor market's holding in there. Even if the down throttles, you have a labor supply constraint starting to emerge, and so it's going to be the unemployment rate that'll probably matter the most next 3 months.
Especially if immigration is handled right.
That's what I'm saying. Well, our leading indicators, they're coming close to zero.
Yeah.
And the immigration, effectively had 80% to do with the soft landing in the labor market. So it was material.
When are you expecting dollar to weaken?
Well, I think it'll be this tension between the tariffs, right, which should push the U.S. dollar up, with the uncertainty that will push growth expectations down. That's the current horse race in the markets. Right now, we're kind of like it nets out, but that makes me nervous because rarely do they. So it'll be the uncertainty tax that'll carry the day.
Given everything that's going on in Europe, so the ECB is expected to cut today.
Yes.
What does it do next?
Well, that's our baseline, some modest easing. I think, though, if you're the ECB, I would be looking at what has happened in the United States in the past 2 years. They don't have to answer this question today, but where's the neutral rate? I don't think it's 2.5%, certainly not below that. So if the ECB had dots, I would say they would be likely moving up in the next several years, and the bond market will start to price that reality. It seems like it's already getting there. Whether or not it sticks, these deficit spending and defense spending has to be structural, has to be permanent.
Where does the UK sit?
UK, I'm actually more optimistic. Again, where I worry about Germany over the next 3 to 5 years is they may have a fiscal thrust. They don't have an AI thrust. UK certainly has had some of the fiscal thrust. We can debate how the positives and negatives, but they do have a better propensity on the AI front. And so there, from a private sector perspective, they have more upside risk.
They also seem to be getting closer to the EU. Unclear if it's only defense or if it's actually a way of getting closer, which could mean also something with trade.
Yeah, no, this is a dynamic that bears watching, right? Because we're seeing shifts in the world order as we speak.
Joe, thank you so much. Joe Davis from Vanguard stays with us, and we'll talk AI and China next. This is Bloomberg. Welcome back. Now, chipmaker Marvell Technology delivering a revenue forecast that actually fell short of the highest estimates. That's disappointing investors who are looking for a bigger payoff from the AI boom, and it's down 14%. This is a story that we've seen over and over. Not necessarily bad results, but actually investors disappointed. In the meantime, Alibaba shares surging after the Chinese tech giant unveiled its latest AI model that it says uses just a fraction of the data required by DeepSeek's R1. Well, we're back with Joe Davis from Vanguard. His book, Coming Into View, How AI and Other Megatrends Will Shape Your Investments, will be released in May. Joe, that's wildly exciting. Congratulations on the book. I mean, this is probably the one thing that at the moment is being lost because the geopolitics are dominating, but that could change everything, our economies, the way we live, and at the end, how you measure things as well.
Well, I mean, again, it's been a labor of love, this project. It's been a team effort, Francine. But I think what we're proud of is looking at all of these major forces that matter. Globalization, tariffs are clearly one. Demographics, aging of society, debt levels. You're talking about Europe, or just a few minutes ago, and then, of course, technology, AI, shorthand for technology. And we're quantifying how all those forces, they'll interact and push and pull. How will that affect equity market investing, fixed income, and growth and inflation? And the results, because it's an empirical framework, we believe we're the first ones to quantify these odds, because we're talking about the future. It's been eye-opening to me. I can tell you the consensus view that the IMF, the World Bank, and the Federal Reserve have for growth and inflation has extremely low probability of ever happening in the next 3 to 5 years because of the tensions between, say, deficits, which can push down, can push up interest rates and down growth, and AI, which could be transformative for the labor market. That's the tug of war that the book talks about. So
AI in terms of what, just massive layoffs because of AI, or can it be used?
It's not. So we're able to look at every job description in the world and what AI can do. I think the misnomer of the debate is AI will augment 3 jobs for every one it automates away. So it's going to be the greatest disruption in the labor market over the next 7-10 years since the computer. But it's not dystopian, other than perhaps for 10 or 15% of the markets. But what the irony of the developed world is why trend growth is low is because we have a lack of automation in the service sector. So that's where it'll offset some of the weakening demographics. And then globalization, I think the fallacy is it's retreating. Actually, it's accelerating when you look at the nature of technology and how it's changing. So, again, we're trying to quantify these for investors, and what do I do with it with my portfolio?
So what is the one thing that you think will actually impact the biggest change in terms of markets?
Yeah, I think there's 2. One is structurally overweighting fixed income, regardless of how the technology plays out. Because if there's deficits dominate, which is the one primary scenario that emerges, clearly AI and technology will disappoint. The more eye-opening to me, Francine, was even if you are belief that the most likely scenario is AI is transformative, about as much as a personal computer, you should not overweight growth stocks and technology stocks in your portfolio. Why? Because transformation leads to other types of companies become more productive in using it, and they're not nearly the valuation level over the next 5 or 10 years. So I'd say for asset allocators out there, whether you are dismissive on AI or you are optimistic on AI, overweighting value parts of the market, and this has happened in every technology cycle over the past 100 years, and we talk about that in the book. That's the winning strategy. Okay,
Joe, you have to come back. I have a million and one other more questions. Joe Davis, a global chief economist and global head of investment strategy at Vanguard. Coming up, as Europe scrambles to protect its borders, we'll discuss what we can expect from the European Defence Summit. That's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. EU leaders gather in Brussels for emergency talks as they scramble to mobilize additional defense funds. Now, the French president says he'll open talks on a European nuclear shield. German bonds fall, extending their worst daily drop since 1990, following the nation's historic spending plans. Plus, the European Central Bank will most likely cut rates today, but tensions cloud the path ahead. Now let's return to the EU, where leaders are meeting to mobilize billions for European defense after the US stopped providing some intelligence for Ukraine. Well, Bloomberg's Oliver Crook is on the ground in Brussels. Ollie, I mean, there are a million things that we need to talk about, but the end question is, can Europe stay united and together on this?
Listen, I think that it's the kind of urgency, it's the kind of crisis that's bringing to the fore radical action that we have not seen from the European Union in a very, very long time. So I think on that front, you're going to find some unity in places that you didn't before. For example, from the incoming German Chancellor, the head of the CDU, Friedrich Merz, who is basically now Germany is lobbying on behalf of the European nations to basically loosen fiscal rules. This is the German CDU Chancellor talking about encouraging the European Union to take on more debt. This is an event that's really without precedent, even in the time of the financial crisis, within the times of COVID. This was not really the sort of German approach to be talking so openly about this. So they find unity there. They will find also unity on the issues of some of the initiatives that have been put forward from the EU, borrowing or lending, I should say, 150 billion euros for more defense spending, and those loosening of those fiscal rules. Where the unity will not be as present is where it often is lacking, and that is on the question of Viktor Orban, the Prime Minister of Hungary. How active will he be in trying to block some of these programs? We know that that the European leaders right now are trying to find ways to circumvent him. They will be able to do that on a number of points. But the two big questions ahead of this meeting is how real is any conversation about the possibility of joint debt, and that will require unanimity among the EU 27, and also the question of Russian assets that are still frozen. Will they be exploratory? Will they be sort of bold enough to start talking very openly about touching those underlying assets to the tune of about 300 billion euros in the absence of that U.S. support, which has been, as we've been talking about, evaporating over the last few days?
Ollie, thanks so much. Oliver Crook there with the very latest from Brussels. Now, as Europe responds to U.S. President Donald Trump's abrupt U-turn on American foreign policy, the stakes have never been higher for both European and Ukrainian security. Now, to discuss all of this, we're joined by Elisabeth Braw, Senior Fellow at the Atlantic Council. Elisabeth, thank you so much for joining us. We have some great geoeconomics analysis from our research team. The latest piece is basically Germany unveils a bazooka, the EU a pea shooter. There's been so much in terms of news to go through. How worried are you about the future of Europe, of staying together, staying united, but also finding a policy that works to defend Ukraine and their own borders?
Well, I think the good news here is that European countries, EU member states, I should say, are acting much more in unity than one might have expected. Even just a couple of years ago, we constantly hear about bickering within the European Union. Well, now that, as you said, the stakes are so high, they are really coming together. Yes, there are a couple of outliers, Hungary and Slovakia, that may spoil the show, as it were, or at least make it more difficult to get on these joint united defense plans going. But nevertheless, this is a massive feat for 27 countries that are very different amongst themselves. Then the challenge is you can agree on defense spending all you want, and that is a massive achievement in itself. But the spending is one part, and getting the equipment is another part. And then once you get the equipment, where are the soldiers going to come from? We already have trouble recruiting soldiers within each EU member state.
So how long can actually Ukraine survive without the U.S.? I mean, this is, I guess, the first question. I know the Biden administration took steps in the final weeks to ensure that it had a little bit longer. Can it survive beyond the summer without European help at the same time?
Yeah, so when it comes to Ukraine, we get different estimates, but the Ukrainians themselves, and that's really who matters in this equation, they're saying they can fight on for another few months. And we should remember they have defied expectations before. Vladimir Putin operated on the assumption that it would only last for a few days. But, of course, it is a major a major problem facing them now. But if they can last to the summer, at least then we can get from existing European stocks and existing European assets, financial assets, more support for Ukraine.
Elisabeth, I mean, again, there's so much to unpack. When you hear, Emmanuel Macron talking about a European shield basically supported by France, does it mean that the current NATO shield is breaking down? Do you expect the U.S. to get out of NATO?
It is an extraordinary turn of events to even hear talk about a European nuclear shield or nuclear umbrella. The U.S. presence in NATO has been a guarantee ever since NATO was created, and I think your viewers will remember the likes of Dean Acheson, who then was not just part of forming all these different arrangements after the end of World War II, but called his autobiography "Present at the Creation." Now we are seeing the opposite from America, which is why this conversation even has to be had about some sort of combined French-UK nuclear umbrella, or possibly a French nuclear umbrella. It is extraordinary. The French, of course, have always been a little bit hesitant about U.S. role in Europe, but now it turns out that the French role may indeed become indispensable.
I mean, is this, the return of the Franco-German axis?
I don't think it's a return of the Franco-German axis. That ship has sailed, or maybe I should say that tank has rolled within the European Union. There are many countries on the eastern flank that are keen to have a stronger voice, but we are seeing the return of the European initiative within NATO, the European pillar within NATO, and frankly, more innovative thinking. So France and Germany were always the engine from an industry perspective, economic perspective, but now innovative thinking, more ambitious thinking from France, Germany, Poland, the UK, by the way, also in a NATO perspective, around what can be done.
I mean, the one thing that I feel is very difficult to answer, that we haven't really, gotten to the bottom of, is what exactly is the nature of the relationship between President Trump and President Putin. What does President Trump need from Putin? Why has there been this 180 in relations to Ukraine?
Well, what seems to be the case is that President Trump, unlike his predecessors, doesn't believe in alliances. He believes in major countries, major powers acting amongst themselves, deciding essentially the fate of smaller countries amongst themselves. And, of course, that leaves very little room for alliances. The core of U.S. international engagement for many years, ever since World War II, really has been that it has alliances, and those allies are its friends and with whom it shares values. But if you don't care much for shared values and alliances, then why should you bother with small countries? I think the drawback of giving that up is that you don't have that core of friends whenever you need friends. But
are you expecting, relations with Russia to be normalized quite soon?
Well, that seems to be the U.S. intention, and we even heard Marco Rubio talk about opportunities for mutual investment. It's an extraordinary turn of events when, at the moment, we still have Western sanctions in place, Russian assets frozen and possibly needing to be seized, and at the same time hearing the U.S. talk about potential business dealings.
Business deals. Thank you so much for joining us. Elisabeth Braw, Atlantic Council Senior Fellow, with a great overview on some of the intricate and difficult questions that we've been trying to answer over the last 10 days. Now, coming up, China outlines plans to boost the economy after setting a bullish growth target despite U.S. tariffs. We'll have the details next, and this is Bloomberg. Now, speaking earlier this hour, China's commerce minister said U.S. tariffs will disrupt supply chains, hinder global growth, and if Washington goes further, Beijing will respond in kind. Now, it comes as economic leaders have been outlining fiscal measures as part of the National People's Congress. Well, Bloomberg's chief North Asia correspondent Stephen Engel joins us now from the NPC's Media Center in Beijing. Stephen, thank you for joining us. So the press conference has just ended. What were your key takeaways?
Well, it was a fairly staid affair for the first couple of hours until a direct question came in on China's response to the Trump tariffs. And that's where Wang Wentao, the commerce minister, sort of unleashed some sharpening words against that trade action. Of course, just yesterday or the day before, we saw the second retaliatory steps on some $22 billion worth of U.S. goods on some tariffs. It's on top of $14 billion worth of U.S. Goods a couple of weeks ago, or 3 or 4 weeks ago, in the first 10%. Now it's up to 20% from the United States. So Minister Wong said this type of coercion and extortion won't work on China. China won't be intimidated. If the U.S. continues down this path, China will continue to retaliate in kind. He went on to say the U.S. should start acting like a big country and get along with others. So those were the sharpest words coming from the Commerce Minister. Some of the other people that were up on the stage included the central bank governor, as well as the Finance Minister, the top planning body head, and the securities regulator, and all kind of towed the similar line that the Chinese economy will have enough stimulus to weather internal domestic economy struggles as well as those external uncertainties. Francine?
Stephen, what are the challenges to China's ambitious growth goals?
Well, I think they alluded to it as well. PBOC Governor Pan Gongsheng essentially said, we have the tools in place. We can cut interest rates. We can cut RRR, reserve ratio requirements, when necessary. It's also a sentiment that was echoed by the finance minister. They put on a brave face. We all know that the property sector has dragged down consumer confidence, and the number one priority, as outlined by the Premier Li Qiang yesterday, is boosting domestic demand, and boosting domestic consumption is going to be at the heart of that. Now, the biggest challenge, perhaps, is the wild card coming from Washington, whether a further tit-for-tat trade war could basically mean China will need more stimulus to prop up its own economy down the road. Most economists that I've spoken to expect China to have given themselves room to add more stimulus, perhaps at the Politburo meeting in April or further down the road, if the external environment deteriorates further. But they do claim that they can have monetary and fiscal levers to pull if the external situation worsens.
Stephen, thank you so much. Bloomberg's chief North Asia correspondent, Stephen Engel. Now let's also bring Yu Ji, a senior research fellow on China and the Asia Pacific program at Chatham House. Thank you so much for joining us. What is the way forward for Chinese growth? Will they be able to hit the 5%, or what are the major setbacks you see going forward?
Well, nice to see you, Francine. I think 5% of target is really an aspiration for this year, considering the worsening external environment and also compared with last year. So I think 5% is really more of an ambition rather than a target that has to be met. However, having said that, if we observe very carefully on the government report from yesterday, there's been extra public deficit being allowed, growth with 30% more than last year. And also on top of that, you may have noticed that the 3 trillion RMB extra long-term special bond being used for consumption boost. So that is to say, the most difficulties in here within China is to drive the domestic consumption. However, having said that, I think that's most of the economists being focusing on. But there's a quite substantive chapter within this year's government report by saying that what China is trying to do is trying to boosting its innovation capability as a way of driving the economy. So while we have the traditional way of saying by driving the domestic consumption, but I think really what really comes to the priority for Xi Jinping's cabinet for this year is again to double down this drive on self-reliance towards innovation and spending money on it. So it's perhaps, I mean, it depends how they play with the ball, really. On the one hand, they will be interested in consumption, but then on the other, I think some innovation capability, that's the key thing.
Usually, can you tell us about inflation? So again, if it's around 2%, how much deflation in this trade war, tariff concern, spectrum do you see going forward?
Yeah, I mean, of course, again, from yesterday's report, I mean, it was inadvertently admit that it's the deflation problem was in China. But how the government is going to go ahead to resolve about it, and I think remain quite unclear for now at this stage. I think for now, the government is very keen to send a positive message, but without backing by substantive measures regarding what to do next to resolve the deflation issue and also to drive the consumption question.
Usually, do you understand, or do you have a somewhat of an understanding what kind of relationship President Trump wants with President Xi?
Well, from my understanding, is Donald Trump obviously want to crafting that sense of personal friendship with President Xi by both of them being a very strong leader and strong man. But then on the other hand, I think what China really wants is China wants to have a calm and functional coexistence with the United States. So that is not exactly what Donald Trump wants. Instead, Donald Trump would be more interested in making deals. And we don't really know at this stage what deal it will be. But nevertheless, I think they want to somehow develop that sense of bromance to Xi Jinping. But I don't know China whether will be able to reciprocate or not.
How much do you think Trump's tariffs will push China and President Xi to change the growth models they've been trying to achieve?
I don't think so. I think I have a quite serious doubt in here. Much discussion in the past few years has been revolving around how to drive China's innovation capability, and much of the policy design, and you would probably see this also in the coming up, the 15th five-year plan as well, with a substantive focus and all the financial and national resources being focusing on technology and innovation. So I think even if we're talking about economies facing very strong headwind, but I think nevertheless, the security question, the national security question coming to as the priority for President Xi, that is to say, he will have to make sure the economy could withstand the geopolitical pressure, could withstand the science and tech export control from the United States.
I mean, I know there's also a number of discussions in capitals in Europe on whether they need to pivot a little bit more towards China because they feel abandoned by the U.S. How much will that benefit China?
Well, I think it's too early to judge at this stage for now because we're kind of unsure how far this support towards Ukraine would last, firstly. And secondly, I think China is also trying to be quite cautious in here and to make sure that, well, by repair its much damaged relationship with Europe on the one hand, but not to irritate Donald Trump, and hence that would actually provoke him to double down the China containment strategy. So I think Beijing for now is sit quietly and watch to see how the situation evolves on the European side.
Usually, if there is a change in consumption and we see that going up, is there a specific data point in China that you'd be watching out for?
Well, I would actually go back to according to your previous report, I said, what is the writing for the next Politburo readout to see whether there will be changing in wording, but also in changing substantive policy from both central banks and the Ministry of Finance regarding how to boosting the domestic consumption. Because so far, what we have is only to providing limited subsidies for buying consumer goods, but that's just not sufficient at all.
But I mean, China also needs, of course, a very healthy industrial sector. That means producing energy. That means producing, weapons, but also being less reliant on the U.S.
Well, I think Beijing has already begun that process of diversification really ever from the end of the first term of Donald Trump already. So if you actually look into the trade data, it is no longer the global north, so hence the United States or EU as the top trading partner with China, but instead it's actually the ASEAN countries and has been the top trading partner with China. So I think China already began with that diversification process, but how further this will go? I think one challenge for China is, given this very prolific sense of manufacturing products being flooded into global sales market, that would also pose as a challenge for some of the global south countries that also interesting boosting its industrial capability. So how further this China's high-end export growth model could go, and they will have some serious doubt in here.
Yuji, thank you so much for joining us, a senior research fellow there at Chatham House. Now, coming up, trading halts in French satellite operator Eutelsat as the company tells Bloomberg that talks with the EU are progressing to replace Elon Musk's Starlink. That, of course, conversation is up next, and this is Bloomberg.
until now, we have been together with Starlink there, but it's clear that everybody's asking us today, can you actually replace especially the very large number of terminals that Starlink has across Ukraine? And that's something we're looking very actively at, yes.
That was the Eutelsat chief executive saying talks with the European Union on replacing Elon Musk's Starlink are intensifying as the U.S. pulls back from the commitments to the continent's security. Now, Starlink has been an essential service for the Ukrainian military over the past 3 years. Shares in the French satellite provider Eutelsat have now soared more than 400% this week. Now, Bloomberg also understands that the Italian government is having growing doubts about closing a $1.6 billion deal with Musk's Starlink in light of the U.S. pullback. We understand that the Prime Minister, Giorgia Meloni, said at a ministers' meeting on Tuesday that the country should look to SpaceX alternatives due to changing geopolitics. Now, Meloni has been positioning herself as a bridge between Europe and the U.S. administration and has a long-standing rapport with Musk. Air France-KLM shares soaring this morning, up the most since 2020. The airline says it aims to lift seat capacity by 4 to 5% this year and improve operating profit by at least 300 million euros. You can see that stock price gaining some 20%. Now, don't miss our exclusive interview with the Estée Lauder chief executive, Stéphane de la Faverie. That interview will be Stéphane's first since taking the job in January. That's tomorrow at 9 a.m. London time. There's also full coverage of the ECB decision from 1:15 p.m. London time here on Bloomberg. You can catch Christine Lagarde's news conference at 1:45 p.m. Up next, Bloomberg Brief with Danny Berger and Manus Crane in New York. And this is Bloomberg.